This is McLeod Insights, where we feature conversations with longtime transportation industry veterans who are now team members at McLeod Software. Our goal is to support and empower our customers by helping them learn about proven ideas and best practices that will have a positive impact on how they run their companies. Let's dive in.
Hello and welcome to McLeod Insights. My guest today is Criss Wilson. Criss is a data scientist here at McLeod Software. Welcome, Criss.
Thank you, Robert.
So, Criss, I know that you carry around a pretty robust resume with you. I know that you recently returned. You did a conference for the TIA in San Diego recently, and how was that event for you?
That was the Capital Ideas Conference, and that was a great event. As a matter of fact, that's the first time the TIAs met since this whole COVID thing, and there was energy in the room. It was their third best attended conference, so it tells you how excited and ready the members of the organization were to get out of the house, to get out of the office, and to start to conduct business in a more normal context than maybe we did in the past. Lots of brilliant people. I'd recommend that conference to anybody, especially smaller brokers, because the TIA, Transportation Intermediaries Association, represents primarily brokers and 3PLs. You've got the ATA, and they represent primarily the asset providers, and then you've got the TCA, and they are primarily asset providers, and many of the members of the ATA are members of the TCA, or excuse me, Many of the members of the TCA are members of the ATA, but not all members of the ATA are members of the TCA. So it's a little smaller organization. The TIA, though, is really focused on making our industry better, setting ground rules, making sure there are ethical behaviors and standards, and that we're not violating them, because the truckload brokerage market in years past, decades past, didn't always have the best reputation, but it's different now.
Yeah, their watchdog group does a really good job, and it's they keep the industry running clean. So you're right, they do a great job.
Strongly educational too. I mean, I've learned quite a bit about buying and selling truckload transportation from the TIA.
Oh, absolutely. I went through the CTB course a few years back, and it was very educational. You get to apply what you've learned in the industry, and they maintain that. So yes, the integrity of that certification is there. So I would recommend that to anyone. Today we want to talk about market rhythms. I know you had this conversation several times before, and we want to be able to help not only our customers but the industry be able to recognize market rhythms that we understand. We don't have we're not the only one who has a rate analytics tool in the market. There are others out there. We do like ours, so some of this may be a little bit impartial to us or a little bit biased, but I do believe that there's some information that you could share with our audience that they could benefit from. But let's talk about what a market rhythm is to you.
Sure. So everything in nature has a cycle. The season cycle, the calendar is a cycle. Trucking has its cycles, and you don't have to be a practitioner of trucking for more than 40 years before you figure out that, hey, there's a cycle. The first quarter is not the same as the fourth quarter of the year with respect to trucking and demand for capacity. And so what happened in the last 2 years is that COVID had really just disrupted the cycle. And for people who may not be in the industry for as long as I have, they're maybe just now discovering that prices cycle. But if they got into the industry in the last 2 years, they have no idea about cyclical pricing because it hasn't occurred. We were in such a disrupted state in the U.S. supply chain all over the world, not just the U.S., but that the spot market basically controlled 95% of the capacity. Very few shipments moved under contract rates. And there were a host of reasons, and we don't have near enough time to get into why, but that was the reality. And what we're beginning to see now is a return to normal. Whenever people said, well, the new normal, I would bristle at that, Robert, because if you understand capitalism, and if you understand free trade, if you understand physics in the universe, all of this says that we operate in a state of equilibrium. Now, for a time, we can be out of a state of equilibrium, but the forces around us will always return us to a state of equilibrium. And so I very much believe in that. COVID was not equilibrium. COVID was nothing close to equilibrium. And we're seeing equilibrium reestablish itself in the market. Trucks are predictably where they should be, not unpredictably where they are. And so we're seeing prices begin to reflect that. The spot market prices are tanking. They were unsustainable to begin with. They were a component of inflation, right? Nobody wants to pay more for something that is worth X. So we're really seeing underlying trends, multiple trends that tell us that contract is gaining traction, and that the majority of the freight in the markets are now moving under contract. And there's any number of indicators we could talk about.
There are, and you, as talking about indicators, we didn't speak about this before, but spot markets prices have been just outrageous and inflated for the last 2 years because of COVID. But as they come down, they're getting replaced by fuel surcharges.
That's correct.
And that's a big indicator that you have to be aware of.
Record fuel surcharges. So if you are a carrier that's pricing on a fixed level, right, all in, as we say in the brokerage industry, fuel, line haul, everything included, you should be changing your price on a frequent basis to reflect the underlying change in fuel. A lot of smaller carriers will resist running on a fuel surcharge, and they do that to their detriment, frankly. You want to index your price so that it goes up and down with the cost of fuel. That's just prudent fiscal responsibility in terms of running, whether you're a broker or a trucking company. But beyond that, as the line haul rates are going up or down, that reflects demand. But if you're only analyzing the total cost of freight, right, you can have fuel displace some of the reduction in the line haul. So you see a total cost per transaction per mile going up, when in reality, if you just look at the line haul, it's going down, and fuel, as you say, is offsetting that. And it is in the line haul, the action on the line haul level, where we can see supply and demand, right? So if line haul rates are going down despite total rates going up, there is a decline in demand.
Let's talk about the lead time for rhythms from shippers, and daily rhythms and commodity rhythms. And, the weeks, the months, quarters. What's an identifier, or how do you identify when, I guess we are, like you said, already coming back to a normal, but how do you identify that?
So when it comes to rhythms, I look for different indications and different numbers in different places. What are the number of tender rejects doing in a given market? Are they going up? Are they going down? Where are they in relation to their average, right? Under normal circumstances, what would the tender rejects out of LA be? And so I know whether or not we're returning to the normal rhythms in the market based on tender rejects. If tender rejects are high, our rhythms are off. Trucks aren't where they should be. Spot market offers are being made, and carriers don't have enough capacity to cover that spot, and so the rejects go up. And they've been as high as 25% in recent history. But they're coming down substantially. FreightWave Sonar measures that. That's one of their key indicators. We can measure that. We can see it in our own EDI module based on tender rejects. How many tenders rejections did we do today? How many this week? How many this month? How many this quarter? And so We know contract freight is taking over because tender rejects are going down. Contract freight is planned freight. Spot market freight is unplanned freight. So when the number of tenders go down, that means the uncovered shipments that are out in the market looking for a truck, looking for a ride, they're beginning to decline. Well, how can they decline if there's still things that need to be moved? Well, that's because the planned truck was where it was supposed to be, and it picked it up on time and delivered it on time. And so you can spot in data analytics, and especially rate analytics, you can spot tender versus contract, and we see contract taking over. And that's one of the ways I can tell we're returning to a normal. The last way, and there's multiple ways, we could have a show just on this subject, is what percentage or how many carriers and shipments are in that long haul and that tweener market. So long haul would be anything 850 miles or greater. And the long haul market is a unique thing in that if a truck goes into the long haul market, it's going to handle one shipment across multiple days. Whereas if a truck is in the regional or the mid-haul markets, right, it could do 2 shipments conceivably in the same amount of time that it would take to handle one long haul. And so we're seeing the number of shipments decline across the board from peaks earlier in March, the 11th week of the year. Basically, we had a peak in the total number of long haul shipping activity. Multiple news agencies have reported it, and our data confirms it. The spot market, the brokers, the 3PLs, their shipments are down out of the Port of LA, for instance, by about 244 shipments a week. And that's a 15% decline from the peak, from week 11, week 12 to today. That's a decline of 15%. The total number of shipments, which didn't get reported, is down 22% out of the LA market. And when you think about that, that is both contract and spot, right? That is both asset and broker. And so that's 566 shipments that no longer occur this week that were occurring back in week 11. And why is that important? Well, because as I said earlier, each long haul shipment consumes a truck for multiple days, which means that truck could have been handling multiple shipments, but it's not. So when I have a truck fall out of the long haul environment down into the regional environment, that's a 2-to-1 pickup. That truck can handle 2 existing shipments where it was only handling 1. And so therein is where capacity begins to free up, right? And you start to see the markets, quote unquote, loosen. Well, the reason for that is because trucks are where they're supposed to be. They're more efficient than when they were handling that spot market freight. They're being run more efficiently, planned more efficiently, consumed more efficiently. And as a result, all of these extra tenders, all of these extra loads that weren't being covered now start to move in a predictable manner, i.e. the rhythm of the market. And then we see them lastly in the rates, rate per day. Monday rates are not Friday rates. End of the week shipping surges, right? Or end of the month, excuse me. Well, used to be end of the week shipping surges. Now we're seeing end of the month shipping surges. That's normal. That's normal. Larger corporations don't like to hold inventory.
Right. Yeah. I don't think that companies believe in inventory the way they did 20 years ago.
Well, I think they're probably willing to keep a little bit more inventory on the shelves, but I agree with you. They would prefer not to hold any inventory at all except for what's on the shelf.
Yeah. So you talked a lot about ports. Can you identify a port rhythm, and what does a gate have to do with a port rhythm?
So ports are very rhythmic. Let's take LAX. We know that the number of ships waiting on a berth has declined. At last count, I just checked the Marine Exchange Facebook page, and they had 35 ships waiting or slow steaming into the port of LA Long Beach, down from 60, 70, 80, 90 ships. Each of those ships, tens or hundreds of thousands of tens of thousands of containers. And so of those 35 ships, only 2 of them had an unplanned delay for their berth of more than 2 weeks, which is fantastic because we were seeing just at the beginning of the year, we had ships waiting 4, 5, and 6 weeks. They had a scheduled berth and they couldn't get into it because it was backed up. And so they ended up waiting ultimately 4, 5, or 6 weeks just in basically not steaming or slow steaming, waiting for their berth to open up. And so that's tens of thousands of containers as it's rolling in. And so the port had to change its rhythm. The port, especially the West Coast ports. What's happened that's not changed, what was I think a more permanent change, ports of Savannah, the port of Washington, Seattle, the port of Mobile, Alabama, the port of Louisiana, the port of Houston have all seen sustained gains in container volume. Why is that? Well, that's because the port rhythm in LA is still not normal. It's better. It's much better than it ever was. But there's still congestion there. And it's probably going to be through the middle of the summer before we get those slow steaming ships down to zero, where the ship arrives and its berth is ready to go. And so we see the port rhythms. The other place we see port rhythms is on the rails, especially the intermodal yards, because let's face it, an intermodal yard is a port. And we also see port rhythms returning to normal at ports of entry, the land ports, right? So Laredo, McAllen, Brownsville, all up and down the Mexico border. The Detroit Bridge, right, between Detroit, Michigan and Ontario, Canada. And so we just see more normal rhythms, more normal patterns. We don't see lines of trucks waiting hours or days to get across a choke point, a bridge, through customs or through the container yards, onto the train or off of the train. All of these things, we're seeing lead times beginning to contract and back to what we would describe as more normal expectations.
Yeah, I believe there's not been anything normal for the last 2 years.
Exactly.
So it would be anyone's guess what is normal who hasn't been in the industry for the last 10 years.
Correct.
So how do you identify as we become or as we get back to a normal rhythm? How do you identify a beginning of a trend and identify the end of a trend if you're in a normal market?
So a trend is a change in direction in a market, be it a change in volume, a change in price, a change in supply, or a change in demand. And there is a cliche, right? Two is not a trend. And so you want to see an observation, a change in direction for more than 3 periods, whatever your period. If you're looking for recession, it's more than 3/4 of down production or gross domestic product. If you're looking in trucking, it might be weeks of declining, 3 weeks of declining demand. In, say, Detroit, Michigan, where a lot of automotive is, or 3 weeks of increasing demand. And so you look regionally, and it's based on the day, week, or the month, or quarter. And it's all really a function of what it is you're trying to measure. The more granular you get with your measurements, the more volatile your results are. Your observations, they go up and down, up and down, up and down. Now, they might generally trend in an average direction, but then you got to use linear regression to figure out if that's the case. So we tend to look at our preferred measure, periodic measurement in the trucking industry is weeks. Weekly activity rolls up nice, and it kind of handles that day-to-day volatility, and you get a really good idea of how strong is demand in a given region of the country, a given market, McAllen, Laredo, San Antonio, Memphis, LA, Long Beach, Arizona, Flagstaff, Arizona. These are all Utah, Salt Lake City, right? These are all transportation hubs, Joplin, Missouri. You watch those points, and they're kind of like the pulse of the trucking industry. And so if you see shipment counts going up or going down, that's a pretty good macroeconomic indication of is demand in the United States increasing or decreasing. Let's remember, trucking is a derived demand. What is a derived demand? Nobody goes to Walmart and says, I want to buy a truckload of apples. They want to go buy a bag of apples. Demand for the truckload of apples comes from Walmart aggregating all of the demand for apples into truckload quantities. And so truckload is a function of somebody wanting something else, right? And so it is truly a primary indicator of the health of the economy of any country if you're able to measure truckload demand. Is number of shipments going up, going down? Is the price for those trucks going up, going down? You can get a real quick read on the economy. You don't need quarterly government statistics to tell you that the economy is in contraction.
Right, and the the rate analytics tools that are available to most companies today will get granular. Like you said, the different zones. If you're wanting to attack a new zone for your company or exit an existing zone that you may not be performing well in, then these tools are a lifesaver for you.
Yeah, they are. We've got a tool in particular in Impact. It's called the home screen. We also call it the winners and losers. And what it looks at are the top 5 markets that are gaining rate, both origin and destination markets, and the bottom 5 markets that are losing rate, both origin and destination. And you can use that tool and you can configure it. You mentioned zones. For folks that don't know what a zone is or don't know what zone they're in, we break down the United States in basically 10 zones. And a zone is a function of the first digit of your zip code. So for me, my zone is 7. I live in Texas, and Texas zip codes begin 7, as do Arkansas and Oklahoma, I think, and Louisiana zip codes. So the whole of those zones is those basically 3-4 states. The whole of that zone. You're in zone 3, and so that's going to be Alabama, Mississippi, Georgia, maybe North South Carolina. So it's that southeast cluster of states, Florida. And so as we look at the zones, we can see which markets are gaining rate and losing rate in each of those zones, both at origin, shipments outbound from that market, as well as destination, shipments inbound to that market. And that gives you an idea, that tool gives you an idea. If you service a particular market and your market makes it on the winners or the losers, there's some action you need to be taking, right? So there's conversations you need to be having. What are we doing with price? How does this affect our net margin? Do we need to take rate action up or down with the customer? So that tool is very handy, and I use that tool to basically look for things to talk about in our newsletter. That's my first consult. I go to that screen and I ask myself what markets are gaining or losing in rate. Recent example, Detroit to Laredo. There's an opinion in the industry that we are entering a trucking recession. I think we're entering a transition stage, but I'm not ready to call it a recession because the contract rates are as good as they've ever been. Outbound Laredo rates, even though they're down from their peak as the spot market cools and the contract market takes over, they're still 30 cents a mile better this time than they were last year at this time. And so no trucking company I know is going to turn their nose up at 30 cents a mile better. Right. So unless you went and did something structurally with your company that causes you to be inefficient, you should be doing really well right now.
Yeah, and talking about going into different markets, it also, most tools have the ability to look at the truck types that you're moving, where a van may be successful in one market, but a flat isn't.
That's correct.
So you can identify that as well.
Yeah, the crazy thing about it was we saw at the end of last year, vans coming out of California were more expensive than refrigerated trucks, even though refrigerated trucks cost more to run. And so refrigerated trucks in a normal market cost more than a dry van does, right? Because there's fewer of them. There's scarcity. They're specialized. They're necessary for specific types of cargo. And so what was happening was the refrigerated trucks that could get good paying freight into LA, they were just turning off their units and hauling dry van freight out because it was to their advantage financially to do it. I've been in this game more than 40 years, and I have never seen such a thing where the van was more expensive than the reefer or the flatbed. But now we're seeing those relationships return in the market, right? Vans are cost effective, but there's a lot of them. Reefers, they're scarce, so they're a little bit more expensive, and flatbeds, for a number of reasons, are even more expensive than that, largely because they have to move long distances to get their next load, and somebody's got to pay for that, so that's baked into the rate.
Yeah, types of freight is a big deal, and I think you alluded earlier that refrigerated rates are going down, but I think because of summertime approaching that they'll probably go back up because of the commodities that are being hauled that could go on a reefer, that need to go on a reefer. So that may become more
spot
stable.
market,
Yeah.
that contract adjusting to normal or to an state of equilibrium. I used to say when I was buying truckload freight for Emerson Electric that 90 out of 100 shipments should be moving contract, and only 10 of those 100 should be moving on non-contract rates. And I really worked my hiney off to make sure that was the case.
Yeah, I think you become more profitable as a company if you maintain more contracts in spot.
Absolutely.
It seems like fast, easier money on spot rates, but to be more profitable, know your cost and know what rates you're charging for, and fuel being one of them. But talk about contract versus spot. What are you seeing with that, and how can customers who have these rate analytics tools benefit from the visibility of contract versus spot?
So the difference between contract and spot was magnificent last year, because contract rates, it was hard to measure contract rates because nothing was moving on contract rates. It was all spot market. But typically speaking, in a normal market, a market kind of like where we are and where we're headed towards, the spot market rates are going to be a little bit more expensive than the contract rates, and there's a reason for it. Contract shipments are some of the most economically priced shipments. And the assumption there, the whole premise for that, is because you've got large asset providers who love contract rates, and the reason they do is because they can plan their trucks, and they can plan them efficiently and predictably, and so they incent the shippers to put them at the front of the routing guide, and that incentive is through price, right? And so those trucks, they get consumed first. They get right of first refusal, if you will, when it comes to the tendering order. And so asset-based prices are generally much more competitive than broker prices. Now, there's no law that says that an asset carrier can't charge what a broker would charge in a given market. But in order to do that, that asset-based carrier is going to need a rate analytic tool that differentiates between the rates asset providers are charging and the rates brokers are charging. Often, brokers will pay their asset-based carriers, their carrier partners, more than the shippers are paying the asset-based carriers. And so knowing where those two markets can be very useful, especially when you have a contract commitment of, let's say, I have a contract commitment of 8 shipments for you each day, 40 for the week. But let's say I'm rotating 55 trucks in and out of there to cover that 40. Invariably, I'm going to have a truck come open at an origin that I didn't expect to have, and I will have met my commitment for the day for the given shipper. What do I do with that truck? Well, I could call that shipper and do a 9th load, and they'd probably give it to me. Or I might have a solid broker partner that I could call and see what they're willing to pay. And so you've got choices. You may not realize it, but you do. You've got choices in the market. And so you can mix your margins based on unexpected surprises. And so our rate analytics tool allow us to differentiate. Not all rate analytics tools will differentiate. Some are an average rate in a given market. The problem with an average rate in a given market that averages brokers and assets is that the average that you get is not a useful average. It's too low for brokers and it's too high for asset providers. And so when you're dealing with averages, you're dealing with something in statistics we call a derivative. An average is a metric that may not actually appear as a rate anywhere in the transaction set that you're analyzing. But it does tell you something useful as long as you're at the lowest common denominator, right? You've got your origin market, your destination market, your carrier type, and your equipment type, van, reefer, or flatbed set. There is a fifth element, commodity. But right now in the trucking data streams in the United States, commodity is poorly documented, so it's hard to use. Now we're working on that. That is a brass ring that the data science team here at McLeod is really interested in deciphering. If we can get accurate commodity rate information, our customers, right, the carriers that move America, our customers are going to benefit from that. So we're working diligently there.
Yeah, I think there's a big difference in moving, say, medical supplies on a refrigerated truck, a van, compared to a load of strawberries.
That's right.
There's insurance that goes different for both those, and could be a huge rate difference in the commodity.
Chain of custody, right? If you're hauling plasma products, right, those are at -5. Strawberries are going to be 40. And so just the amount of diesel that reefer unit consumes at -5 versus that load of strawberries at 40 or 35. That alone is a tremendous cost that has to be differentiated in the rate.
Yeah, I think we have to do a better job in the industry to identify truck types and commodity being hauled.
That's right.
Because the company themselves are the one who loses out on it.
Especially if they have a claim, right?
Yeah. Oh, yeah.
And then with insurance being what it is, we've got more of our carriers that are self-insuring. Well, what does that mean? That means that they take out a policy that the first $250,000 of the loss is covered by them, and then the insurance company kicks in. That's what we call self-insurance, really high deductibles. Well, a load of plasma products is well north of $250,000. And so if you're going to be hauling plasma products with your reefers, you're going to be paying more in insurance rates to your insurance carrier because it's a risk and reward.
Risk and reward. There were a lot of companies that I spoke with, some of the smaller asset-based carriers who said, hey, rates are so attractive on the broker side that I think I'm just going to sell my trucks and move over to be a broker. And as rates normalize, I wonder if that conversation is changing.
It's harder to be a broker in a contract market because the net margins, they require a spread between your buy and your sell. And so when you have record-setting spot market rates, well, it's easy. But when you are living on the edge of the knife, it's not so easy. You got to cover your transaction cost. And so there are metrics that we use in data science that tell us how efficient our broker customers are, how well are they utilizing, and their number one cost is labor. So how well are they utilizing their labor? And that's where our products come in, right? TMS is well constructed, formatted, and configured, do a lot of the work that a human would otherwise have to do. And that's why I think McLeod is experiencing such a record demand is because this cost of labor is very real, and anything a company of scale can do to automate is towards goodness. And on the bottom line.
Maybe more on the brokerage side. I think there's a positive and negative to both the broker and asset side about negotiating those freight rates. And I think that we'll have a conversation about that at a later time. But there's an art to negotiation and the visibility that you need to be able to negotiate properly. We've never claimed to be financial experts here, and we're not going to attempt it today. But I did notice that credit card spending is down, or it's kind of paused at this time from what I'm reading. And how do you see that affects the retail market that our trucks handle?
So ultimately, retail, for the everything that is made physically and sold in the economy at some point goes through the retail supply chain. So from box to consumer, right? Big box stores, small box stores, mom and pop shops, craft shops. They demand things, they transform those things, and there's an inherent value created. And as a result, demand for those things is what trucking basically serves, right? So when credit card spending goes down, typically what that means is we're buying less stuff. Now, it's also possible that we're changing what we spend our money on from stuff to experiences. So when we were stuck in the house, COVID, we looked around at the house and said, boy, my stuff needs updating. And so if we didn't have the cash, we whipped out the credit card because there were deals on stuff. And we wanted to get those deals while they existed. And so we saw people improving their home. They were cocooning, maybe buying new furniture, outfitting an office. I certainly did. My office at home is much nicer than it was prior to 2020 because I'm in it a lot. And so retail credit card spending is one indicator. When I look at trucking and I'm trying to predict which direction it's going, there's basically four things I like to look at. The first one is the money supply. I think it's the M1 money supply. That is the number of dollars printed by the U.S. government. Whenever you print more of something or make more of something, it becomes worth less intrinsically. That's supply and demand. And it's true for dollars. And we dump at least $3 billion into the economy in printed money, and so inflation was a foregone conclusion by anybody that is in the trades of supply and demand. Economists, manufacturing, we were all saying, well, here comes inflation, and sure enough, here it came. Now, the other place that I'll look for is rail car loadings, because at the end of the day, if trucking is a canary in the coal mine for the retail space in terms of a leading indicator of changing demand, then rail car is a canary in the coal mine in terms of manufacturing writ large for the whole United States. And so I look at things like coal, I look at things like metallic ores, I look at things like lumber and chemicals, because these are the feedstocks, right? And I can tell you if the housing industry is getting hotter or colder in terms of demand based on the rail car loadings of lumber. Because at the end of the day, a housing start is dependent on the lumber being on the ground so you can start to build out. And so minerals, non-metallic minerals, stone, crushed limestone, cement, all of those things tell us what parts of the economy are either expanding or contracting. And that then tells me, what those parts of the economy are going to do to trucking and on aggregate and individually. And you can see with great correlation the beginning of every recessionary period in the United States. It's reflected sometimes as much as 6 to 9 months prior to the actual beginning of the recession in the United States. And what happens is rail car loadings just tank. And so that's a good one. I look at the average overall rates for trucks. Are they increasing or decreasing? Therein you can trick out what's happening with demand. And then there are some other things that I look at, but one of them is in impact. I like to look at the winners and the losers because I can equate the regions of the countries or those markets with specific industries, right? So if we see rates going up week over week in Detroit, Michigan, we can deduce that the automotive industry is spinning up. There's a higher demand for freight. And in fact, that's true. And if you look at the rates between Detroit and Laredo, there's some very impressive results being booked in spite of, quote unquote, an overall freight recession. So I don't like to paint with a broad brush. I don't like to say we're in a freight recession or a trucking recession because that takes an average number position to measure. And that average basically negates what's going on in individual regions of the country. Yes, we may be in a freight recession. I think it's premature to say it. I certainly wouldn't. I don't have to. I'm not chasing a news cycle. But what I tend to do is to point to areas of the country that are bucking the overall opinion of the talking heads in any given industry. That's what data science should be doing.
Yeah, I agree with that. I have a burning question that you talked about a minute ago that I want to ask you is the length of haul. I know that we measure the length of haul, and you talked about it coming in and out of the ports, the length of haul for certain companies. But do you believe that the day of the long haul trucker, most companies these days the drivers want to be home every night, so they become more regionally based. Absolutely. Do you believe that the day of the long haul trucker is gone, or do you see it reemerging?
I definitely see it reemerging. Now it's dependent on something that doesn't quite exist yet, but it's coming. It's coming, and that's autonomous vehicles. So there is a natural competition between intermodal trains and long-haul trucks for that particular freight that moves more than 2 days, or takes at least 2 days to move. And so it's all very cost sensitive in that particular length of haul grouping. If you can afford to wait, you can save 10-15% by moving it intermodally. When we go to autonomous trucks, initially they'll have drivers. They have to. The trucks are still in the learning state. But at some point, those drivers should be able to go to sleep or rest while that truck is moving over the road, because that truck's purely capable of doing it safely, more safely than with the driver. And so the driver becomes kind of like the final mile. And we see this already in airlines, right? When you take off the first 10 minutes of the flight and the last 10 minutes of the flight, that's human-guided navigation. The pilots are flying the plane. At points in between those 10-minute windows, that's all fly-by-wire. That's the computer that's flying that plane. Air-gapped as it is for security reasons, the computer on that plane is in control of that plane. And so we're going to see that. The railroads are already starting to work with autonomy to the extent the unions will let them. And we've seen here at McLeod a great deal of activity and a great deal of progress. And there's any number, 6, 7 companies out there right now who are notching level 5 autonomous shipments, meaning that truck drove itself with no one in it, all by itself, with no control or oversight, and it literally went from dock to dock. And so when that becomes the order of the day, when the great majority of the trucks out there are operating autonomously, I think the railroads are going to have some price competition in terms of what an intermodal container or intermodal trailer is worth, and they're going to have to get more efficient as well, because there really is a break point. We call it an economic break point between intermodal and long haul trucking. And the only time you would want to spend money on long haul trucking today is if you really needed that, if that freight was required to keep your plant running. Otherwise, if I could afford it, I'd put it on the rail, if I could afford it in terms of time.
I agree. The time is the factor there.
Yeah, absolutely.
The rates are very competitive.
Yep.
Rates are competitive for a lot of companies, and I know that we're going to continue our conversation with negotiating those freight rates and contracts. So stay with us, and we'll continue the conversation with Criss Wilson, our data scientist, on the art of negotiation. Thank you very much.